Good afternoon, good morning, good evening, depending on where you are today as you're watching this webinar. We're glad to have you back again today. We have a lot to talk about, and I see some questions already coming in. Some very good questions, but I think we'll cover several of them in the presentation today, but if not, we'll be sure to try to answer them at the end. Let me get my disclaimer slide up to meet our compliance requirements here, give you a chance to look over this slide as we talk. USDA had some surprises, some market impacting surprises in today's report. Basically, they raised corn, soybean, and wheat yield estimates today. They lowered the overall corn and wheat harvested acreage estimates. They raised soybean harvested acreage estimates. So as you might anticipate, soybeans took the short end of the fundamentals today, getting the more bearish fundamental adjustments in this report. And that resulted in some spread activity, and particularly within wheat. We saw Minneapolis getting the better end of the wheat spreads and corn getting the better end of the corn soybean spreads as the market reacted to the numbers today and kind of readjusted to what USDA had published today. Now, price is a function of supply and demand as modified by the flow of money. So we will start with the flow of money and what's impacting that. And I will say here right up front that we've got a lot of slides today. And I won't spend a lot of time on many of these slides so that I can spend time on what I think is most pertinent, but I still left them. I cut some of them out, but there's just so much to talk about today. But I left what I did in here so that you can watch the on-demand version and you can hesitate or pause and study those slides a little bit more. But first of all, let's talk about the Federal Reserve. It has continued to pause its interest rate. Now, the expectation is that it will cut its benchmark rate at the September meeting, September 18th, I believe it is. The market today was pricing in roughly 50% odds of a 50 basis point rate cut. I'm not expecting that. It is possible because this Fed seems to very well know what market expectations are. And to this point, it's done nothing to change those expectations. I personally think it would be a mistake to do so, but that doesn't mean that it won't do so. In fact, the market was pricing in 4 cuts by the end of this year. In other words, 100 basis point cut earlier today when I checked. By the end of this year and continuing more cuts next year. And right now, I think that would be a mistake. Let me go into it a little bit more. When you look at GDP growth for the second quarter's latest data out, 2.8% growth, that's a solid economy. When you look at manufacturing capacity, it continues to trend higher. When you look at the job cut numbers, they're at historically low numbers right now. People are not getting laid off. Yes, there are some, but from a historical standpoint, the number of people getting laid off is very low. When you look at where's the money coming from to keep this economy going, I grabbed this slide before last week's rout in the stock market, so that's why I scratched out the word has and put had. A record high 30% of the population had a stock market portfolio worth more than $500,000. And the bigger portfolios get, the more confident the consumers get, the more money they spend. And remember, the biggest portion of these stock portfolios individuals is among baby boomers who are retiring. If they've got the money, they're happy to spend it. When you look at home values, 37% of the population has a home worth more than $500,000. And that means home equity to borrow against. And when you see interest rates drop like they did this last week, that means home equity loans, the more courage to take out home equity loans, I should say, as well as refinancing their existing loans in order to cut their house payment, giving them more money into pocket. Now, some of the new loan activity may depend on consumer confidence, and we'll see if the consumer confidence has been rattled. We'll get consumer sentiment at the end of this week. I dare say that data was probably taken before the crash in the stock market, so I'm not sure how much I put into it. But the key right now is to quickly reassure the consumer. This break in the stock market, this rout, it was said on all the headlines to be about worries about a recession, but it had more to do with unwinding of the yen carry trades with Japan than anything else. And that resulted in a sell-off of finances and a weakness of the dollar. And that created fear on Wall Street. Oh no, what's happening? Before they really took a look and recognized what was happening. The computers kicked in and added to those sell orders, and the rout was on. But we have moved toward a more stable, more orderly unwinding of the yen carry trades now. And hopefully we'll be able to reassure the consumer, and we'll get some more solid economic data. But I've got some more here to show you as well. As we look at default rates, loan default rates, they're trending lower. When you look at the consumer price index, the headline number is now back down to 3%. We'll get this updated on Wednesday of this week. The general expectation is that we will continue this move down. That's the market expectation. The core CPI is still up there at 3.3%, but of course expected to continue to trend lower. That's still well above the 2% level. So when does the Fed kick in, and how aggressive does it become? And my stance is it needs to be very careful about getting overly aggressive, because there's still money in the system, as I've shown. And I think the core of the economy is still good, even though we have parts of the economy that are struggling. The producer price index, which is inflation at the wholesale level, is trending higher. And that's something the Fed needs to pay attention to. Our monetary base is still trending higher because of all the fiscal stimulus programs that are still in our economy. As Congress is still pumping money in to their economy. Weekly data for same-store retail sales looking rather healthy right now. If we look at U.S. air travel, look at that red line at the top of the chart. It's still doing well. We're still seeing growth there overall. And I think that's going to be key. Here, it's showing you this number right here, if I can circle that. No indication, that's just a seasonal decline right there. Nothing more than that. We're still above past years, up there, record levels for this time of year. When we look at the labor market, that is becoming more balanced. Now, the last jobs report got a lot of blame for that rout on Wall Street, and is even one of the most dovish members of the Fed, Austin Goolsbee, said that is not a recessionary jobs report. It wasn't. And we still have more job openings posted than what we have people looking for a job. And when you look at the unemployment report, there's a lot of economists saying, remember the SAM rule. The SAM rule is not really a rule, it's an observation that when the unemployment rate goes up by more than 0.5% over a 6-month period, that a recession is imminent. But that rule may not apply here, because the unemployment rate is not going up because of people getting laid off. It's going up because we're adding people to the workforce, mostly through immigration. If you break down the data, that's what I see. And so I don't know that the same rule really applies here. I don't think so. Now, the unemployment rate, and here I mentioned the unemployment rate going up, but look at where it's at. It's still at historically low levels. Weekly initial jobless claims, really within the range of where you might anticipate them being. Here again, as we look at this red line there with the current year weekly jobless claims. Okay, so let's just kind of summarize this. Restaurant bookings are still strong. TSA air travel data shows still a lot of strength in travel. Tax withholdings, no sign of a slowdown. We look at the weekly data. The Atlanta Fed GDP now is projecting 2.9% for the next quarter, for the third quarter that we're currently in. The Fed's weekly GDP index is at 2.2%. Retail sales are strong. Jobless claims are slightly weaker. Hotel occupancy rates and daily rates are strong. Bank lending to firms and consumers are growing. Bankruptcy filings are trending lower. Credit and credit card data is solid. Global jet fuel demand is rising. Broadway show attendance is strong. Box office weekly grosses are higher than normal. S&P 500 forward profit margins near record levels. Business formation is slightly weaker. Temporary worker staffing index is trending lower as well. So that's a quick summary of what we see in the economy right now. Now, as we look at our national debt, upper left-hand corner, I've circled it, 35.1, almost $35.2 trillion. Right next to the right is our annual tax revenues for the current fiscal year. Now, come down there to the big long circle there, and toward the center, toward the right of that circle, I have interest on debt, net interest payment. That's the cost to servicing our debt, our annual cost. That's been trailing higher. And I posted on social media last week, that number would likely exceed what we spend on defense and wars each year over the weekend. And sure enough, it did. Look, almost $917 billion currently to service our debt annually. What we spend on defense and on war efforts, $916 billion. So it's now, and that's not sustainable. Social Security, $1.462 billion. Medicare and Medicaid, $1.798 trillion. If you add those four things together, those four line items together, that comes to about $5.1 trillion, a little under $5.1 trillion. We haven't even dealt with Homeland Security or education or USDA programs, food programs here in domestic food programs. There's a number of different discretionary spending programs. Haven't even got to it. We've already spent all of our tax revenue for the year. That's why we're building these deficits right now. That is the problem we're dealing with. Now, why do I bring that up? Because as I've been saying, my concern is going to be we're borrowing money now to pay the debt, pay the interest on our debt. So we're borrowing to pay interest on our debt. That means issuing more debt certificates. So what we've been watching is, and we saw this play out this last week, is when does credit start getting tight? And when you look at the unwinding of the yen carry trades, what was that? The Bank of Japan, on the same day, only in Japan it was Wednesday, the end of July 31, sooner than it was here in the States, the Bank of Japan decided to raise its benchmark rate by the most that it's raised in 15 years. That ended 8 years of negative interest rates. For many, many years, investors were borrowing against the yen at those low interest rates in order to invest in our markets. That means they had to buy dollars to participate in our markets. And so that means they were big buyers of our debt certificates as well as our equities. That's what they began to unwind. When Japan did that, the Bank of Japan did that, and then later that same day, which would be that night in Japan, we saw the Federal Reserve essentially give the market what it wanted, indicating, yeah, there probably would be rate cuts starting in September. Then investors said, we need to get out of our yen carry trades. And they were racing to the door to do that. And they're still just at the early stages of doing that. But the initial stage was a panic, get out the door. That's why we saw equities being sold off. And initially, we saw a lot of that equity money going toward the safety of government treasuries. And that masked Japanese investors pulling their money out, or people who had done the yen carry trade back pulling out of the treasuries. Keep in mind that Japanese investors were the #1 foreign holders of U.S. debt certificates at $1.2 trillion, I believe it was. So initially, that rush to safety masked it. But then once another member of the Bank of Japan came out and says, no, we're not going to raise interest rates again until the market stabilized, then we started getting a more orderly move of unwinding the yen carry trade. And that meant that that rush to safety of other investors going to the treasuries that was masking Japan pulling out was no longer there. And we had an auction of 10-year and 30-year treasuries, and we saw some problems. It wasn't a good auction. And what this graphic here does is give us an indication of overall how strong is the demand for those debt certificates relative to the supply of debt certificates. And so you can see this last one on the right side, that this is for 10 years. On the right side there, that's at a historically high level of concern. And that is what caught the market's attention then later in the week last week, and why we saw treasury yields really start to pop again, coming well off of their lows. That's something we need to keep an eye on, and something I've been warning about for months, really for about the last 8, 9, 10 months. I've been warning about that. And I think that's going to continue to be a factor going forward until we get spending under control. Now, when you compare growth in government debt toward nominal GDP, the left-hand column there shows growth in government debt outstanding since December 2019 has gone up $11.6 trillion. Growth in government debt outstanding since December of 2020 is up $7.1 trillion. So that's after a lot of the COVID spending. Growth in nominal GDP since December of 2019 is up $6.7 trillion. So you can see that we're rapidly expanding debt much faster than we are GDP. Now, let's bring it home to the commodities. And you've seen this chart before if you've been following my webinars. And this shows our StoneX commodity tracker, which is a basket of, I believe, 27 different commodities, the value of them versus the U.S. 5-year break-even inflation rate. You notice at the bottom there, the statistical correlation over a 10-year period is 0.87, which is anything over 0.70 is considered a strong statistical correlation. And you can see that we saw inflation expectations last week just really plummet. And so did the commodity prices. We saw an exit out of the commodities as well during that. Now, the correlation with inflation is also at 0.87. So when inflation expectations go down, the funds tend to short the commodities. Now, when we look specifically at the grain and oilseed sub-tracker versus the CPI, that correlation is at 0.88. You can see how we're waiting to see the next CPI number later this week, but grain and oilseed sector is continuing to go lower now. Now, let me back up here and show that we've seen that us break through that level of chart support now for the 5-year break-even inflation rate. So in other words, we are solidly in now a commodity deflation mode once again. And so we're seeing the funds really short the grain and oilseed and the livestock sector. And specifically, when you look at all the different sectors, the weekly performance chart here from our StoneX commodity tracker, and those of you who are staff at StoneX or customers of StoneX, you can find this on our market intelligence portal. If not, reach out to us and we can guide you to it. But if you look at this, it almost gives you the impression that the managed money has been shorting the rest of the commodity sector against the grain and oilseed sector because of its fundamentals. I did want to briefly put in here, what's the impact on the ag economy? We are seeing year-over-year change in non-real estate farm loans really push higher now, upward just shy of 15%, which is the highest we've seen since the late 1970s. And where is that debt? Well, it's mostly in the larger operating loans. And so you say, okay, that's a big increase percent year on year. Is that at problem levels? And so what we did is we look at it from a nominal standpoint. We're still pretty much in the historical range of the last 14 years or so. It is rising. It is trending higher. It is something we need to watch. But when you look at overall non-real estate debt, which is primarily operating notes, there's still at levels that are not that unheard of, similar to the late teens of this century. So I'm not real panicked about this right now, but we are looking at perhaps another bad year this coming year, and so we'll probably see that number increase again. I want to show you, I haven't shown you Chinese economic data in a while, and I want to show you again how the birth rate is declining. And those of you who read my commentary this morning will read about the projection that their property sector, which is really in the dumps right now, may continue to struggle, because despite all the stimulus that Chinese government is providing, because fewer people, and they're anticipating that as we get in the 5-year period ending in 2030, that there's going to be a lot less demand for housing. Go back and look at that commentary if you get a chance, or reach out to me on it, because of this declining population issue. If you look at the Purchasing Managers Index, PMI data for manufacturing in China, any number below 50 means month-on-month contraction. And that's quite a string of months now that we've primarily seen contraction in the manufacturing sector, and their economy is so built on that. You look at M2 money supply that's available for consumers there. And on the left, we're looking at year-on-year change, and on the right as well. And you can see how that is really, we're just not seeing the growth on money supply like what that economy needs in order to sustain growth. Consumer confidence is really hurting, therefore, as a result. When you look at foreign direct investment of, money coming into China's industries, et cetera, down 29% year on year. That's a significant problem for China's economy. And when you look at CPI, Consumer Price Index, yeah, they're getting some positive numbers there, but look at the Producer Price Index. It's been negative really all the way through all of this year and all of last year. So some significant problems there for its industry going forward. Now let's look at weather risks. This is a graphic of July temperatures, average temperatures by climate district. Now, if you'd shown me this back on June 1st, I would have said, we're going to have some big crops this year. Look at the Midwest is very mild. This is out of 132 years of weather data. And this next graphic is rainfall, above normal rainfall. And if I'd seen those last two, this graphic and the previous one on June 1st, I would have said, we're going to have big crops this year. If you look at history of July temperatures, the lack of 90-degree days in the Midwest in July, this is what this graphic shows. There's a star there by every year going back to 1980, where July had as many days at 90 degrees for a high this year in the Midwest or less. And so you see there, the only year out of those that had a below trend yield was 1996. And so that's why the trade was anticipating an above trend yield from USDA today. And USDA gave them even more of a yield for corn and soybeans than expected. Now, I went back and looked at the last 30 years of weather data, because I looked at Scott Irwin had challenged on X, formerly Twitter. Scott Irwin's, many people know him. He's a professor at the University of Illinois, and he had posted on X that he questioned our yield estimate for the state of Illinois from our customer survey, which came in at 210 bushels for Illinois. And he said, if you really look at similar years from the past, it should be somewhere between 220 and 230 bushels. And lo and behold, USDA came in at 225 bushels, which I'll show you in a little bit. So that got me thinking, and I went back and looked at the last 30 years. I found 6 years when yields were 5% above trend or more. And I went to this website, this neat website where you can create composite maps, and I looked at August weather conditions in each of those years combined, a composite of all the 6 of those years combined. And you see the years listed there: 94, 2004, 2009, 2014, 2016, and 2017. 2018 was just below the 5% above trend yield. And if you put those years all together, Midwest was cool and wet, basically 1 to 2 degrees below average temperature for the month of August, and anywhere from a half inch to 1 inch, 1.5 inches above normal to the half inch to 1.5 inches above. Not that different from what this August is expected to be, although I'm not convinced yet that we're going to see that much rainfall. I think we're going to have sufficient rainfall, but temperatures are looking like they may be very similar by the time we're all said and done. So that tells me we do have more upside yield potential, and the market's going to assume that with this forecast if it verifies, because this is looking more similar to this year. And I looked back at these 6 years. The average increase above trend for those 6 years was 7.69%. So if I apply that to this year's trend yield, that's 194.7 bushels per acre. Now, this is not Suderman projecting a yield of 194.7 bushels per acre this year, but that does say that with August looking very favorable as well, we have to brace ourselves and prepare for the possibility of higher yields in September and October, and maybe significantly higher yields, because when you're this cool, what does it do? It slows down the maturation of the crops, which gives you a larger seed size, and a larger seed size is very hard to detect with crop tours just looking at it, but it does show up in the combine at harvest, and that means higher yields. And so that's something we're keeping our eyes on going forward. And we've already had the acreage adjustment today. Now, there are probably more acreage adjustments, but the biggest was expected to be today from the FSA data. So that means most of the production changes going forward are going to be tied to yield, and the expectation is yield going up for corn and soybeans. If you look at the sea surface temperatures, it's been a lot of change in the northern Pacific. A lot of change. And we see that this area right in here that had been hot is now cool, but this heat has moved into here. We're still hot over here. We're still hot over here in the Atlantic. And mostly we've seen this high pressure set up here in the south. And sometimes it drifts over here into this desert southwest in the Four Corners area. And so we've been getting northwesterly flow over the top, which has been providing our thunderstorms, which I warned in June was, I thought, a risk for this year based on the climatologists that I've been listening to. Excuse me. See if I can keep my voice through this overall. We are seeing a move toward La Niña here in the central equatorial Pacific, but it's been very slow to develop. It's been kind of an up and down thing. The models still say we go to La Niña, a light to maybe almost a moderate La Niña during the South American growing season, but we'll see. And what strength of La Niña will it be? That really impacts what kind of weather patterns to expect in Argentina and Brazil. As we look at the United States, this is the European models for the September, October, November time period. And this is a very La Niña-like on the left graphic there, with dry to the south. Now, the one caveat to this is the Gulf of Mexico is still very warm. And so we could have a very active hurricane season as we go into the end of August into early November. And that could give us a lot of precipitation in the south. We don't know that. We don't know how many hurricanes there will be or tropical storms. We don't know the path of those storms. Will they continue to curl off primarily to the east? Will they come into the Gulf? If they do get into the Gulf, the conditions could end up being very favorable for development. What will their paths be? We don't know that, but I'm just saying be careful about assuming the south will be dry like what we see in that left graphic. December to February are primary winter months. This, again, is fairly La Niña-like, maybe a little bit more rain in the southern plains, or rain or snow than what I would have anticipated, but that's kind of the pattern overall. Colder to the north, warmer to the south, precipitation in the east over the Midwest and up the east, up the Ohio River Valley, That's kind of what the Euro model is anticipating at this time. Now, as we look at South America and you develop some analogs for the September forecast, you come up with what we have on the left there. That's pretty generous rainfall for Argentina to start their growing season off. Their wheat would really welcome that. Their corn and soybeans would welcome it to start refilling the soil profiles after a long drought. That would be very good for them. It's still pretty early for planting, though, in September there. Brazil, kind of a mixed bag, but looks like they might get enough moisture to go ahead and start their planting season, which this year they can plant earlier. In most areas, they can plant soybeans earlier than they could in the past, as early as September 1st. So if they get showers, which right now they're still devoid of showers, if they get showers, they'll be able to plant earlier this year, which means harvesting earlier, which means planting their winter corn crop or the safrinha corn crop earlier in January and February, reducing the risk for that crop. Now, Commodity Weather Group is not quite as optimistic in their forecast on the right for Argentina and Brazil, but we'll see. Let's look at the longer-term Euro models. For September, October, November, that's the planting season in Brazil and getting started in Argentina as well. And you see it has rains for southern Brazil and northern Argentina and some drier risks in the rest of Argentina, but not totally dry. And the same is true for center west Brazil, but the monsoons could be starting late according to this Euro model forecast. But then look at the December, January, and February months, which are the primary winter production months. It kind of flips to some extent. Argentina's still a little bit on the dry side, but that's not totally dry. It's going to come down to temperatures, but good rains for center west Brazil, where that one area is pointing toward Mato Grosso, which means we could finish off the soybean growing season well and then have good moisture for the safrinha corn season. Again, a lot can change. It's a long ways out. Forecasts beyond 10 days don't have exactly a very strong confidence, but that's the general trends that are currently expected. Let's look at the fundamentals. Okay, wow, last month we had a huge surge in wheat production estimates. So big crops get bigger, right? That's kind of what the trade expected. Well, what did USDA do? Well, they trimmed the crop. They cut it back. Part of that was because of, in fact, the biggest part of that was a reduction in acreage. And so spring wheat acreage in particular. And so we did see a little bit of a trimming of the spring wheat yield. We saw the winter wheat yield go up, and we saw spring wheat acreage come down. And so they got closer to what I thought spring wheat acreage was going to be last March. If you remember my projections in my webinar back then. So the bottom line is now we're back below 2 billion bushel crop. And so that was the good news. The bad news is that's still a lot of wheat that we have to move through in the rest of the marketing year. On the corn and soybean side, higher yields there, higher yields than what was anticipated. An increase was expected. It was even more than what was expected, as you can see here. And certainly both were higher than what our customer survey showed as well. On corn, this is looking at yield changes versus last year. Yield changes versus last year. Look, Iowa up 8 bushel. And look at Illinois there, 225 bushels per acre. That's a new record, I believe, up 19 bushels over last year. So increases for North Dakota, South Dakota, Nebraska, Kansas, Missouri. Look at 28 bushel increase for Missouri, 8 bushels for Iowa, Wisconsin increasing, Illinois up 19 bushels per acre. We see Indiana up a new record high there. Ohio, though, a 10 bushel decline right now. So you can see kind of where the new bushels are coming from. Soybeans, see the changes in yield year on year there as well. Most areas seeing growth in their yield this year. If we look at U.S. ending stocks, that's the bottom line that impacts price movement going forward. 828 million bushels of wheat projected for this current marketing year. That's down 28 million bushels from last month, but that's still a lot of wheat. Corn down, what is that? About 23 million bushels down from last month. And the corn market reflected that today. That's still a lot of corn. We're still above 2 billion bushels. But we mostly saw support in corn today come from the spreading, unwinding soybean corn spreads and putting some new ones on, with soybeans taking the short end of it. Because look at that, increased acreage, 1 million more harvested acres of soybeans versus 700,000 fewer harvested acres of corn. Yields are higher on both, but that acreage really made a difference. And now that big acreage adjustment's been made, and the expectation will be yields going higher. Now, as we look at these ending stocks projections, I'm going to show you the demand estimates. I still think USDA's got some fluff in the demand estimates, and I'll break that down a little bit. Global numbers, the soybean number is the big one that really stands out there. 134.3 million metric tons, up from 127.76 million metric tons last month. The corn and wheat number actually down a little bit. If we look at ethanol use for corn, pretty much on pace for hitting USDA's target, either on pace for hitting it or maybe we exceed it by up to 10 million bushels is what it's looking like right now. Export shipments, USDA bumped their export target up again today, and putting in that new export target for the current year and they also bumped it for next year as well. But bumping that for the current year. Now I'm having doubts, so I'll look at that a little bit, whether they increased it for the new year. The old year they did another 25 million bushels. So that means that marketing year-to-date inspections fall short of the seasonal pace needed to hit USDA's target by 51 million bushels. Now, perhaps they're seeing in the census data that there is a lot of corn of late that is not showing up in the numbers yet, that is not been inspected, that is being shipped. There usually is a lot, but it doesn't tend to vary that much from year to year. But maybe it has been. Maybe USDA knows something we don't know, but based on face values, I look at the data, it looks like USDA is going to have to pull that export target back down for corn. If we look at export sales to Mexico, we're up 47% year on year, and that's been our savior this year. New crop soybean exports, oh, my error. I got the wrong chart in here again. I was trying to show you new crop corn export sales. It actually looks similar to this. It's a similar, we're behind where we'd like to be, but we're turning higher. If we look at the corn condition ratings, above average for most areas, and you can see what my model is. Now, our official yield estimate comes from our customer survey, 182.3. My yield model at 184 will update here later this afternoon when we get USDA's crop ratings in for this week. Now, as we look at USDA's current marketing year numbers for the year that ends August 31, it's in the first column. They're projecting ending stocks at 1.867 because they bumped exports another 25 million bushels. Okay, and yeah, they took new crop up to 2.3 billion bushels. I'm at 2.275 for my new crop. I'm at 2.195 for old crop. So I'm not as optimistic as USDA. When I look at my world balance sheet, I can't justify it. My numbers are higher than what they were, but I can't justify numbers as high as USDA has them yet at this point. I do think it is possible, if you make some adjustments to Black Sea corn production and to Argentine corn production for this coming year, that USDA is not yet done. So if USDA acknowledges reductions in production in those areas, then those higher export numbers might be justified. But I don't think you can justify them doing what they did today in exports without making those adjustments in their world balance sheet for Argentina and for the Black Sea. That's my problem I have with them. Now, I left my demand numbers basically the same, but I did adjust acreage numbers to match USDA so we can compare apples to apples. And my new crop ending stocks estimate is 2.056 billion bushels. So that is lower than USDA, even though my old crop ending stocks estimate is higher than USDA. Give you a little bit of feel. But what if it's 190 bushel yield? That pushes ending stocks up there close to 2.7 billion bushels. That's what we don't want to get. And that's assuming that demand doesn't change. And frankly, demand would change. If we go that high, we're going to see lower prices, and that's going to buy some demand. But I wanted you to see the impact overall. Managed money has rebounded with short covering. We didn't see much of a price increase with that short covering, which is a reflection of all the farmer corn now coming to town as they're cleaning out the bins to make room for this big crop coming. If we look at soybean shipments, as I said, previous meetings, webinars, typically we trend higher to close out the marketing year on shipments, but instead we're trending flat. And that's why we were on pace to hit USDA's, not only to hit USDA's target, but my target is still 5 million bushels above. Now we're falling behind, that we're losing at surplus, but I'm sticking with it. We end up with exports about 5 million bushels above USDA right now. When we look at why the big drop again, it's because Chinese commitments are down 21% year on year. If we look at new crop sales, which you saw this earlier, we have finally started ticking higher. The only year that we're above now of recent years is the 2019-20 marketing year. It was during the trade war, but I still argue the even bigger factor that year was roughly 2/3 of their hog herd was wiped out by African swine fever. They just didn't have the demand. If we look at soybean crush, one of the big factors was, as the market realized at the end of the spring, that we were importing a tremendous amount of used cooking oil from China and other Asian countries, more than what logic suggested that they had available to sell. And there were many in the industry who thought maybe they were just taking cheap virgin palm oil and injecting enough used cooking oil in it to make it test positive as U.S. cooking oil, and allowing them to claim, processors to claim the bigger subsidies by importing that. And Reuters now reports that the EPA is investigating. We cannot confirm that, but Reuters reports that the EPA is investigating these massive imports of used cooking oil. And so when that report came out, we did see a surge in soy oil prices and a bump in canola oil prices as well. And that could help us bring that crush total back upwards again. But right now, we're just kind of on pace to hit USDA's target for the current year. I have a little higher crush target for this next year. This shows you the massive increase in used cooking oil imports from China in 2023, and then 2024 is year to date. So we're on pace to exceed last year right now. Here you see the soybean condition ratings generally above year-ago levels, above the 5-year average, and you can see what my model is for yield. Again, our official estimate is the customer survey at 52.6. My model's at 53.8. If we look at the soybean balance sheet again, USDA comes up with 346 million bushels of old crop ending stocks. I'm at 349. That becomes beginning stocks for the new marketing year on September 1. I here too adjusted my acreage upward to match USDA's. I kept our yield from our customer survey. And you can see, therefore, that my ending stocks isn't that much different than USDA's, but certainly that's an abundance of soybeans. I also have a 55 bushel yield in there to show what is possible based on this August weather pattern. Again, that's not a forecast, show what's possible. And a 50 bushel yield. Right now, I don't see much evidence we're going to be below 50, and the 50 gives you ending stocks at 363. Nothing for the bulls to get excited about. So today's report is what gave managed money the confidence to sell soybeans, to buy corn against soybeans in the spread. Okay, just a minute, trying to get my voice here. See if that works. Excuse me. Okay, as we look at soybeans, managed money still very short there, and today's report won't help that. Spring wheat is the crop that we're most interested in yield right now. You see the crop ratings there. And I wanted to show you this inserted table of this year's crop ratings by state and how much the condition index score for 5 of these states, well, 4 states and then the U.S. total, is above the 5-year average. That just shows how incredible this is. And remember, the crop tour of North Dakota had yields at possibly 30-year highs. So that's how good the crop is. If we look at USDA's ending stocks number, right now we're in the new marketing year, so that's 828 million bushels. That's still a lot of wheat. That's very close to my estimate of 830. And again, I changed acreage, but left everything else the same. If you look at where that wheat is, the biggest problem right now is hard red winter wheat. Hard red winter wheat stocks at almost a 200-day supply. That's the biggest problem right now. Soft red winter wheat stocks are growing now as well as hard red spring. We are seeing a decline now in white, and durum stocks holding relatively steady as a percent of annual usage. But we've got to find a market to move that hard red winter into some extent soft red winter. And that means trying to price themselves into feed market, but that's hard to do when you have 2 billion plus of ending corn stocks and expectations that yields are going to go higher. So that's the battle. Wheat has, let me say it this way, wheat has been showing signs of the world cash market bottoming out. So that means that maybe futures can bottom out, but not if corn continues to make new lows. If corn continues to make new lows, and I know he's saying, Suderman, it went up today. It went up today because of the spreading, but historically, we're not out of the woods on lower prices until the market's comfortable with how big the crop may be. And the fact that the yields went up more than expected today and August weather suggests they may go higher, I wouldn't get too comfortable with this rally in the corn market today. So that does mean that we are vulnerable to lower corn prices that could pull wheat lower again as well. Even though corn put in an outside higher trading day, a key reversal on the charts, that many times that's bullish, but we've seen it before and it didn't work. So be careful. If we look at managed money, has been coming out of its short positions in Chicago soft red winter amid these signs of maybe a carving out a broad bottom. Not so much for Kansas City and not so much for Minneapolis. So our take-home points, and then we can take a look at the questions that we have. Corn, soybeans, and wheat yields get bigger today. Acreage were adjusted upward for soybeans, down for corn and for wheat. The markets assume that big crops get bigger, and remember, we've already made the bigger of the acreage estimates is what the market's going to assume. Wheat, we should be getting close to now, although the spring wheat crop, we're just at the beginning of that harvest, so we could see some notable changes there. USDA confirmed ample supplies of corn, soybeans, and wheat today. Nothing bullish in this report at all. Commodity deflation is the current mantra of the money flow. Keep your eyes on Argentina and planted I'm sorry, it should read Argentina and the Black Sea. That I totally messed up that statement there, and I was editing it. Keep your eyes, this is what it should say, keep your eyes on Argentina and Black Sea corn acreage estimates. That means for the Black Sea, where the Ukraine war is going on, what do we see in corn production plannings for next year? Argentina, I've heard from two different sources, totally separate, independent sources, that corn acreage will be down 25 to 30% this year. That removes a big part of the margin for error if La Niña is a problem for South America this year. That's a big if, but that is a realistic if. And so that's something to keep your eyes on. When I hear a number that big, it makes me skeptical, but with the disease problems they had related to the leafhopper spread of the disease this last year and the current economics, it's very possible, that big shift. Where will those acres go? Mostly to soybeans. So again, that's bearish soybeans. The weather bulls need to pin their hopes now in the Southern Hemisphere. The market's going to assume that the U.S. crop is mostly made. If it turns off hot and dry, which is possible yet, we could still take the cream off the top of this crop. But overall, we're not looking at a crop failure right now with the forecast that we have. And so the market bulls are going to have to really pin their hopes on the Southern Hemisphere for now. And with that, there's my contact information on X. We're ready for some questions, and I see we have about a half dozen questions in there, so let's take a stab at them.
Do you think that feed and residuals usage for 23 and 24 should be revised down, or at least the USDA should not have revised it up in July?
Yeah, Marco, I agree with you on that. I think USDA's overdid their increases in feed and residual usage for both old crop and new crop. It's like they were trying to solve for an ending stocks estimate that wasn't too big, and I do expect that to come back down at some point.
Regarding the new crop, they adjusted the exportation up 75 million bushels, and in the books, they were at the pace of July's estimate. Is it not overdone?
Yes, I think so. Good observation there. I do expect that. That'll be something we have to deal with later in the marketing year. The exception would be for the new crop is if we see the big drop in Argentina and we see a drop in Black Sea, and USDA acknowledges that to be the case in the months ahead, and then we have some problems related to La Niña in South America for the upcoming crop. That would be the exception when maybe we could justify those export numbers.
I see the price of soybean falling to a level that will induce the contraction of planted area for the 2025-26 crop. Do you agree?
Oh, I think that's possible, but the Midwest farmer is going to plant, and he's going to plant primarily corn or soybeans, and typically they will stick with their crop rotation. The big changes in acreage between those two crops tend to come from the periphery areas around the Midwest, in the plains, in the South, and not from the core of the Midwest where the bulk of the production comes from. And so I don't see anything yet that's going to cause a major shift in acreage in the Midwest, because you're right, the soybean numbers from today do not look encouraging, but neither are corn. And when you look at fertilizer prices, crop input costs versus what's being offered now by the marketplace for the coming year, there's not a lot of encouragement to plant corn either. But the farmer in the Midwest is not going to idle those acres. He's going to plant some. He's going to plant generally corn or soybeans. And so what's it going to be? And with soybeans, he can double crop wheat in many parts of the Midwest. And so if he plants soybeans, so soybeans and wheat combined is also part of the budget process there. So at this point, I don't see a major shift in acreage in the core of the Midwest where the bulk of our production is.
Is there any reason for fund money to cover their short positions on the back of these higher than expected corn yields?
That's a good question because of the big short positions on. A lot of times when you get to that point, and I've been getting this question, does that mean that the funds are going to cover their shorts? And that's always possible because you could get a headline maybe related to the Middle East conflict that could maybe create a short covering rally. That is certainly possible. That aside, right now with the farmer still being the big long, I think the fund manager feels very comfortable in his position, and I don't see an imminent risk of that. Can't rule it out, but I think the fund managers are very comfortable right now in it.
Everybody is saying that the crops for the Black Sea countries will be heavily affected due to drought and hot temperature. Do you expect to see SFO to be at a substantial premium to SBO and RSO?
I don't think USDA is fully accounted for the weather problems Black Sea. I think it has for wheat. It was interesting to note that they cut European wheat production by 2 million metric tons and shifted it over to Ukraine essentially. So that was a little bit of a surprise. As the Russian crop, they have at 83 million metric tons, and that's probably pretty close to where the final number will be. When it comes to the oil seeds, that's where we could see some shifts and some problems, some tightening up. That's another reason I think why we have seen some support for soybean oil and canola oil prices, particularly if we see the EPA crack down on imports of used cooking oil. So that's where we see the most potential for some volatility related to any further reductions in the Black Sea. And I'm not sure the USDA is fully accounted for that yet.
How long does managed money stay record or near record short across most major ags?
Yeah, I think as long as there's not a fundamental story pushing them out, which there currently is not, and as long as we're in a commodity deflation mode. And I showed you that the expectations for, the 5-year break-even inflation rate breaking below chart support, that's highly significant. If we see that rebound quickly with reinflation pressures come back, then we actually could see a significant short covering rally. Remember the rally we had back in late April, early May? That was largely a reinflation short covering rally. And that could repeat again, but so far we're not seeing those inflation expectations turn higher again. That's what needs to happen again, like it did in the spring, and that's what we're watching for. So far, we don't see it.
Are the percentage harvest assumptions accurate? Have we seen the full extent of earlier weather issues being reflected in acreage or more to come?
I think there will be more adjustments. I think we have probably seen the biggest adjustment. I expect if there's more adjustment, it'll probably be to harvested acreage. I would anticipate that we'll see more downward adjustment to harvested acreage in the Northwest, Midwest. I think the question will be, will some of it be offset by less abandonment in the central and eastern Midwest? But I do expect both corn and soybean harvested acreage to get trimmed modestly, I'll say it that way.
Can you confirm that Argentina corn acres will be down 25%? Would you be bullish the corn curve?
Yeah, if I can confirm it down 25%, would I be bullish the corn curve? That depends on how we're setting up the weather and the amount of acreage being planted in Brazil for the second corn crop. I would say that that would be a significant factor in the fundamentals. It is not enough by itself. If we are going to grow a big crop here in the United States now, and if Brazil has favorable weather and does not reduce area planted for its winter corn crop. But if we see Brazil trim its acreage that it plants in winter corn, and we see La Niña being a factor, and Argentina cuts 25%, and those three things are possible, But until I see that, I'm going to be reluctant to be bullish on the corn curve. Okay, that looks like all of our questions that have come in. If you have additional questions, feel free to direct message me on X, formerly Twitter. Thank you for being with me today. September, USD adds another point. They will do their objective field sampling for the September report. That adds another bit of unknown to this whole thing, but the expectation will be big crops get bigger, but by how much? So that'll be something to watch. We certainly have a lot to talk about. We'll also have better information on the weather pattern to start the growing season in South America. So be sure to be back with us next month. Once again, thank you again, and be careful. Thank you.